Hi, hello everybody. I think everybody is super happy. Now we comes with a beautiful topic, Ind AS 36, impairment of assets. This is the first standard we take. So out of the standard discussions, first three standards will be this, Ind AS 36 and Ind AS 16 and Ind AS 38. All these three standards are interconnected. There is a connection between the topics. And the other specialty is all these three standards are asset-based standards. So that means it gives guidelines related to asset recognition, measurement, right? So out of that, the first standard we take is Ind AS 36, impairment of asset. It's a beautiful standard. When we coming into final level classes, there's something exclusive discussion. That means it is not discussed in your Ind AS levels, right? That's it. So now from an exam perspective, this is normally tested for a 7-mark descriptive question. Alongside this can also be tested for a 2-mark MCQ question. So there's a usual trend. The standard is testing in exam, right? That's it. Now the discussions will be in an order like, first I discussed what is correctly an impairment means, and then slowly I'll discuss how do we calculate, and then we slowly discuss the special matters and guidelines related to this standard. Ready? So first officially we moving on to what actually an impairment means. Remember, in simple sense or in an unofficial way of explanation, I'll say impairment simply means it's a loss in value of, losing means reduction in value of a fixed asset. As of now, I'll say fixed asset, right? That's it. So it's a value reduction to a fixed asset can be called as impairment, right? But sir, wait there. We have a confusion. What was depreciation, sir? We learned depreciation also like this, right? So that we have a confusion. Ready? So remember, before coming into impairment, I'll make sure what actually a depreciation means. Then I'll come back to impairment again. Ready? That's it. First, depreciation, as you know, it is also a reduction in value of fixed asset, but it is specifically due to 3 reasons. Number 1, wear and tear. That means once you purchased a machinery or a car, once you started to use it, of course, the value will be reduced. It's a common reason, everybody know. Ready? And the second reason is efflux of time. That means movement of time or passage of time. Let's say an example. You purchased a car. Normally, once you start to use it, of course, the value will get reduced. Everybody know it. But remember, let's have a situation. I purchased a car and I parked this car in my porch for 6 months without any single usage. I just parked in my porch for 6 months. That means I'm not used this car for 6 months. Then I'll ask you a question, whether you get the same price you purchased before 6 months after this parking for 6 months. No, you'll never get a value which is equal to the purchase price, because 6 month time is gone. Maybe you're not used it, but time is moved. This is the second reason. Ready? So there's no compulsion you have to use for the accounting depreciation. For the accounting depreciation, there's no compulsion that you have to use it. Clear? That's it. So this is the second reason. And the third reason, just a minute. And the third reason is obsolescence. That means technological innovations. Remember, normally, especially when we're coming into gadgets industry, when an old technology overtakes with a new technology, when a new version comes into the market, then of course the value of old version will get reduced. So these are 3 reasons we're covering in depreciation. So what is depreciation? let's say it's a reduction in value of fixed asset due to this three mentioned reason. Ready? So, and you know that depreciation we usually calculate, let's say, right, we have a total cost, let's say 10 lakh, you purchased a car for 10 lakh and we estimate that total useful life is 5 years. Just imagine, right? And we have a zero scrap value. Just imagine for the sake of business. So then we calculate the depreciation. Every year we calculate the depreciation. 10 lakh minus 0 divided by 5. We get a depreciation 2 lakh, right? This is we account every year. Even if actual real depreciation or value reduction is more than this or less than this, this depreciation is not a real depreciation. We just calculate the depreciation based on its useful life, right? So here we are not bothered about actual depreciation, maybe more than this or less than this. Let's say an example. During this current year, your car is had a lot of physical damage, scratch. In that year, actual depreciation may be more than this 2 lakh. But we are not bothering, we are not checking actual depreciation with a mechanic. No, we just take 2 lakh every year. That's over. That is we calculating in depreciation. But remember, what is impairment? Then I'll say, it's a loss in value of fixed asset due to any reasons other than depreciation. We have many other reasons for value reduction of a fixed asset. But depreciation specifically means it's a value reduction due to that three mentioned reasons. So actually, what is impairment? Clearly, let's say it's a value reduction to a fixed asset due to any reasons other than depreciation. So tell me some reasons other than we see in depreciation. Now, that is the next discussion we are going to make, right? Listen, we have a lot of other reasons. This reason is named as indicators, right? Value reduction indicators. This is broadly classified into two ways: external reasons and internal reasons. External reason means a reason which is not in the control of company. It is maybe because out of company's matters, economical issue, market issue. Ready? Now let's see what are the external reasons for value reduction. Ready? So let's discuss one by one. The first one, adverse effect of technology. That means negative impact of technology. Remember, you have a machinery which is used to produce the typewriter. Remember, typewriter is just a product of your fixed asset machinery. Typewriter is not our fixed asset, not this point. Typewriter is not our fixed asset. Machinery is my fixed asset. But that machinery is used to produce that typewriter. And you know that this typewriter has been outdated from the market and the desktop computer come to the market. Remember, once after this changing in this technology, whether anybody purchased that old machinery using for typewriter? No. That means that machinery used for typewriter production value will get reduced. This is the first reason. You get the sense? Adverse effect of technology, right? That's it. When the product producing from my fixed asset is outdated, automatically the value of my fixed asset will also get reduced. Clarity? Okay, that's it. Now the second reason is adverse effect of market. Here we have a negative impact of new competitors in the market. Let's say an example. We have a machinery that is our fixed asset which is used for a product called Nokia mobile. You remember this nostalgic mobile phones, right? That's it. But remember, once after the season, this Nokia outdated from the market and the smartphone era comes to the market. Once after this change in era, remember, people will never buy a machinery which is used for Nokia production because Nokia product is not at all marketable. Then why I have to buy the machinery used for production of Nokia? That means once after this new competitor called Samsung smartphones comes, of course the old product outdated. Once older product is outdated, then of course that machinery's value will also get reduced. Here we have a negative impact of new competitors in the market, right? That's it. That's another reason. The third reason is adverse effect of economy, right? Remember, you have a machinery which has a remaining life of 6 months and currently it has a market value of 1 lakh. That's the current status of your machinery. But there is a news spreading in our nation that from the next day onwards, India is going to lock down for next 6 months. Just assume. Ready? That means next 6 months, no operation can be done. That means this machinery cannot be used for next 6 months. In such a situation, people will never buy your machinery because you only have a remaining 6 month age, and that 6 month the India is in lockdown. So that means the machinery become valueless, right? So in such situation, people will never buy your machinery at a good price. Your value will be reduced. Here, the negative impact of this lockdown, that is an economical reason. Ready? So this is a 3 reason, or simply let's say adverse effect of technology first, market second, and economy third, right? That's it. Another reason is abnormal decrease in market value. Abnormal decrease in market value, right? Remember, you know this, Apple's iPhone 15 Pro. But remember, suddenly the Apple is releasing their new series 16 Pro. Of course, there will be a sudden decrease in the value of 15 Pro after the introduction of new version. Once the new version is released, automatically the value of that old version will get reduced from the market, right? This is not normal decrease, it's an abnormal decrease. Hey sir, we also said obsolescence in depreciation. So is it same? Remember, though we cover only normal expected obsolescence or technological changes. This is not normal. This is unexpected. Ready? So the market is not expecting this new version coming. Ready? In such a situation, there will be an abnormal decrease in value of old version. Ready? So in short, these are the external reasons. Adverse effect of technology, market economy, and abnormal decrease in market value. And there is one more reason called increase in interest rate, but that I'll discuss later. Ready? After you become okay with the calculation, then only I can connect with the concept. Ready? So this let it be pending, right? That's it. Now we're moving on to internal indicators. Simply, these indicators are because of companies' issues, not out of company. This is internal issue of companies. Let's see such kind of reasons. Number 1, physical damage. Remember, during this year, your car got damaged or physically a bit scratched. Right? So of course, this is not covering in depreciation. In depreciation, we only cover a regular amount of value reduction. Ready? That means due to this physical damage will be reduced. Ready? Value will be reduced. Another reason, significant changes in use. Remember, every machinery or every fixed asset will have a purpose, right? Remember, we have a building which is currently used for hotel apartments or a residential purpose. Ready? So, but remember, unfortunately, after 2 to 3 years, in your location, there's no marketability, there's no customers. So you plan to change your building and you make some structural changes and you converted this building for a go down, right? Let's see. So remember, you changing the purpose of building into another purpose. Ready? From the resident purpose, you change it into go down purpose. Remember, when you sell, when you use for this purpose, that means a resident purpose, generally you will get a more value. And when you sell it at this point of time, then people will give you a fairly good price compared to go down purpose, right? That's it. So in short, once you change it, the use of asset, there is a chance for value reduction. I'm not saying 100% there will be a value reduction. Maybe sometimes value increase, maybe, right? Because once you change it from go down to residence, there is a chance for value appreciation, right? But here we cover there may be a case for value reduction, right? That's it. Another reason, internal reporting about worse performance. Ready? Let's say you have a machinery as of now in 2014 March. Currently, it has a value of 6,000. Just imagine. And this was purchased for a total cost of, let's say, total cost of 10,000. Ready? Just imagine. Ready? And this was purchased on 2010, 1/4/2010, and it has total life of 10 years. As of now, 4 years got expired. Now we have a remaining life of 6 years. So you currently calculate depreciation like this: total cost, which is 10,000, minus scrap value nil, and total life is 10. Ready? And of course, every year you charge a depreciation 6,000, and once after 4 years expired, now we will have a WDV of 6,000. So on this date, an internal audit is doing in your company. Ready? Just imagine. And the internal auditor checking the real performance of this asset, and they take an external valuation of this asset. During that valuation, the actual remaining life is not 6 years. They say only 4 years remaining life. Remember, only 4 years remaining life. It actually don't have a remaining performance for 6 years. It only have a 4 years. In such situation, you were expected 10 year, but actually it has a 8-year useful life. In such situation, you have to suddenly cut down your value, because during the last 4 years you calculated the depreciation on 10-year basis. If it was doing based on 8 years, you will have more depreciation, right? That's it. So in short, in such a situation, on that date you have to have a sudden write off your asset. Ready? There will be a sudden value reduction due to internal audit about bad performance of your machinery. Ready? So this are the reasons other than depreciation, right? So in short, from all this case discussions, I'll sum up my points. Simply, what is impairment? It's just a loss in value fixed asset due to any reasons other than depreciation. That's my core point. Loss in value fixed asset due to 3 reasons. Mentioned reason is called as depreciation. Due to reasons other than that is called as impairment, right? Now, there's a big difference between depreciation. Other than this point, there is another big difference between depreciation and impairment. Remember, depreciation is regular and systematic. That means every year we charge a 2 lakh depreciation. Let's say an example. But every year we charge 2 lakh depreciation. Even actual depreciation is less than or more than that. We are not minding. Every year we cut 2 lakh. Ready? But impairment is not charging in every year. This is unusually charging. That means whenever your company feels that there is an impairment indicators like we mentioned earlier, then we check for impairment testing, and if there is a value reduction in that year only, we take impairment loss. That means this impairment is not regular. This is suddenly happening. Every year the physical damage or abnormal decrease is not happening. This is unusually happening. So in short, Depreciation is regular and systematic, but impairment is irregular and unsystematic. That means when only there is a impairment reason, then only we charge impairment loss. But depreciation is not like that. Depreciation charge every year. That's it, right? So അങ്ങനെയാണെന്നുണ്ടെങ്കിൽ now I list out all these reasons. This is the official reasons. This is the external reasons we have. Adverse effect of tech market and economy, abnormal decrease in market value, and this is a pending item. We'll discuss it later. And here we discussed in general INDAS. I think you're perfectly okay with actually what is impairment. Ready? Now we have to see how we calculate the impairment or impairment testing. That is our next thing we have to discuss.